connect with the management of Lakshmi Vilas Bank then. The company delivered its Q1 numbers. Unfortunately, it was a loss once again this time around. But on a sequential basis, the losses have compressed a bit. So from 622 crore rupees that they delivered in the previous quarter, it's now come down to 124 crore rupees. But the NI as well has declined on a year-on-year basis. Provisions, however, as well have come down significantly on a sequential basis. So let's understand what exactly transpired in the quarter gone by with Mr. P. Mukherjee. He's the MD and CEO of Lakshmi Vilas Bank. He joins us right now on the show. Thanks so much, sir, for joining in on ET Now. It's a loss for the second quarter, albeit, of course, for a smaller quantum. But what exactly is it that's leading to such pressure on the earnings?
Very simply, it's a question of the stress in the book that was weighing down the portfolio. To that extent, obviously, that has affected the interest income. So I sense that going forward, obviously, a lot of this is gradually clearing out. I must point out the positives to you straight away. You pointed out in any case that the loss has reduced, the provisions have reduced. Going forward, from my understanding at least, the provisions are going to be much less. And even as far as the residual stress in the book is concerned, it's obviously well under control. If you ask me, going forward, I frankly can't see more than 200 crores of the corporate book being under stress. Rather, some of the MSME numbers have spiked a bit. Between MSME and retail, I would say I might identify another 400 crores or so of stressed book. But that's about it. The book looks relatively clean today. Going forward, the provisioning requirements for the next 3 quarters also seem to be quite small, actually, relatively, if I might say so. So I think I've seen the worst of it for the bank. Going forward, it's now for us to really turn around the book and see how we can increase the revenues.
All right. Mr. Mukherjee, you spoke about stress in certain areas, but yeah, I'll come to that in a bit. But your gross NPA stress does remain high. So if you could just tell us a broad outlook on what the slippages were, what the recoveries were, and if there were any upgrades versus last quarter.
Yes, indeed. This quarter we saw total gross slippages of 395 crores. And against that, we had recoveries of about 280, recoveries and upgrades of about 284 crores. In addition, I had another separate 1800 crores of written off accounts recovered. In fact, cash recoveries alone were to the extent of about 100 crores. So clearly, the recovery drive has started. My own sense is this year at least I should be able to recover 700 to 800 crores. Which should significantly improve the position as far as my NPL ratios are concerned. As far as the slippages themselves are concerned, the single largest slippage was an account of 30 crores from a trading account. So you'll appreciate that the bulk of the slippages were really granular in nature.
Okay, so your slippages were at about close to 395 to 400 crores and you're expecting recoveries of 700 to 800 crores. So that's good to know. If you could just identify which broad sectors or segments you are seeing stress, and also if you could talk about the NI growth. It has contracted significantly. What is the reason for that and what were your margins like?
Well, you would have seen that the NIMs, of course, had fallen to a low of about 1.35 in March, but they've recovered to about 1.48 now. It is now a function of how I am able to recover from the bad loans, which will push up my spreads. The good news is definitely on the CASA front, where we seem to be consistently improving. And now we have now reached a steady state basis. Even on a daily average basis, the CASA is nudging 20%. End June number was in fact 21% in CASA. So CASA is helping. It's now for us to see how well we can position the recoveries to boost my NIMs and my NII. I'm hopeful that at least my NIMs should recover the 2 levels very soon.
All right. Okay. Mr. Mukherjee, just an outlook on how you see your NIMs shaping up going forward, because we are going to see interest rates rise. So what will be the outlook on margins and what's the rise you expect in your cost of funds and your yields?
An interest rate rise not necessarily would affect adversely, but my sense is by the year end I should be showing NIMs in the region of 2/4 to 2/2.
All right. Okay. Mr. Mukherjee, what exactly are your plans for the next 1 or 2 years? If you could talk about the key focus areas. Also, how open are you to inorganic growth?
Well, quite frankly, inorganic growth is something that one would look at in due course, subject to the opportunities available for all concerned. But the immediate focus, of course, is to build the granular business for the bank in the form of SME and retail growth. And subject to, of course, how soon we can bring in more capital, that growth should start pumping profits for the bank.
Okay. And what about advances and deposit growth? What was that like in the first quarter and the outlook over there going forward?
Our deposit growth has been quite robust. The focus, of course, has been on CASA, of course, which has been growing faster, of course. And overall growth was about 22%, but CASA has been doing well. And the expectation is that by the year end, advances growth should be in the region of 10 to 12%.
Okay, all right. Mr. Mukherjee, we leave it at that. Appreciate you giving us your take on what Q1 was like. There was a bit of pressure on account of, stress seen on the books, and that is something that did cause the company to post a loss in this quarter. But yeah, he did give a good outlook in terms of recovery. So really appreciate you giving us your time, Mr. Mukherjee. Then.